Welcome to the Pulse Check podcast. Walter de Oude, partner, founder and CEO at Chocolate Finance, previously also founder at Sing Life and various other senior executive roles and board member roles in the insurance industry. I've seen it all. Great to have you on board on the podcast.
Oh, nice to meet you, Salomon, and thanks for inviting me to talk about my stuff.
Yeah, great. I'm sure we can fill a lot of hours with all your experience, but before we go into details, the number one question I always ask is, what defines you? What makes you you, Walter?
Wow, that's a big question. I think everybody's a bit different there, but I guess what makes me is a passion to just build cool stuff, right? I built a business called Sing Life, which was designed to change the way we think about life insurance and to digitize that whole aspect. Now that I've done that and been successful at it, everybody says to me, "Oh, why aren't you sitting on a beach somewhere doing something else?" But I'm not built that way. I like building stuff. I like finding solutions for problems that everybody has, which led me to build the chocolate finance business that I'm building now. And I absolutely love every day of my life in doing what I do.
Yeah, absolutely. And that's also what I feel, the passion that drives you. I'm also not the person to lie on the beach, by the way. So if I'm not running the business, I'm a runner. No, the passion is important, I think, for a startup business. And also having the right vision. You really look like a visionary. Everyone knows you in Singapore for that. So maybe you can describe first a bit the vision you have overall, and then maybe also specifically to Chocolate Finance.
Yeah, sure. Look, I think the world is changing, constantly changing, and changing more quickly every year. We all know this. We all see it all around us. And so the question really is, how do we as individuals adapt to being a part of the changes that we see everywhere? And how can we take these changes and actually make them valuable to consumers? I'm not a B2B guy. I'm a consumer guy. I love brand. I love individuals. I love consumers. I love retail. I love doing things that are going to make an impact on real people's lives. In the same way as I found that, when I looked at solutions around cash and cash management, the existing traditional businesses are not really optimized to serve what I need. And so we decided to build something which I think is good for me. And then if I think it's something that's useful for me, it should be good for other people to also look and maximize their cash. So the world is changing, so how can we adopt and change with it?
Yeah, absolutely. And I've seen your app, even though I'm not Singaporean here, I cannot use your app as much. I've seen it, I have to say, really well done in terms of experience. And I think you address a very important point. It's the everyday person, as you said, the normal people that may not have also the full access to finance as maybe more the high net worth individuals. Brings me also a bit to the topic of democratization of finance and how to make it accessible to everyone. Of course, having a bank account is normal in Singapore, but really having the same service level. And going into some of the specifics, I see that, for example, you target customers also with a 3.5 annum interest rate. So maybe you can quickly explain how this is possible and how will this also progress, because in Hong Kong we have 8 virtual banks that launch, and they also target customers quickly with very interesting interest programs, but then over time they struggle to become really profitable and as such successful. They're still working on that, and some of them will come close soon. But how is it for Chocolate Finance specifically?
Yeah, look, I think first and foremost, Chocolate Finance is not a bank. We're an asset management company, but what we do is we use more up-to-date technologies and asset management techniques to be able to provide services that help customers with their cash management at a higher level of yield. And we can do that because we're not a bank and because we've completely and fundamentally differently structured. But the story really behind where Chocolate began was actually something that I built at Sing Life when we were an insurance company. And for insurance companies, the biggest problem insurance companies have, or all companies have, is distribution. How do you sell more? And insurance, nobody wakes up in the morning and says, yay, today's the day I'm going to go and buy some life insurance. And so that's why insurance companies tend to require distribution networks and access to customers beyond just their own portals and digital access. That's why in insurance world, bank assurance is such a powerful means of distributing to customers, because you get access to customers who already have an engaged platform for discussion on money matters, which is their bank account. So bank assurance, bank engagement, activity, the opportunity to talk to customers leads you to the ability to sell more insurance. Now, when I was at Singlife, we were a startup, and startups don't have billion-dollar checks to go and write bank assurance deals, right? So at the time, I thought, well, if the engagement model is to get closer to customers' cash relationships, and cash being the most engaging financial services offering that there is, why don't I just build a product that looks like a bank, feels like a bank, does what a bank does, and offer that kind of a service to build my own internal way of engaging with customers. So at Singlife, what we did was we called it the Singlife account, and it was an insurance contract where you can put money in any time, take money out any time. We gave a crediting rate on it, put a cool app on it that did cash management services, right? And the idea really was, if you can funnel customers from a cash engaged model, you can then upsell them into higher order, higher value products as an insurance company. And it worked so well. It worked brilliantly in that everything that we knew to be true about customer behavior and engagement around cash bore out in practice. All we needed to do was offer a slightly better return than what was available in the market, and customers would flock to our platform, and that's exactly what happened. In fact, it worked too well when I was at Singlife, in that it grew so fast and furiously that the amount of capital that we had to put behind it became a limiter to how much we could continue to grow. So, as an insurance company or a bank, the more deposits you take, the more capital you have to hold, pretty much, right? So when the time came for me to start something new, knowing how successful the Singlife model was around the Singlife account, the view was, is there a way to build this where you don't need to have the same amount of capital so that you can actually scale it infinitely rather than be restricted as you grow? And an asset management framework actually allows for that. The difference really between us as Chocolate Finance or a bank or an insurance company is that a customer's money with a bank or an insurance company goes onto the bank's balance sheet or the insurance company's balance sheet. It's an asset of the insurance company, and your policy or bank account is a liability of the bank or insurance company, right? But with an asset manager, it doesn't work that way. Your assets are actually held in a separately ring-fenced, segregated, custodized account. It's not part of Chocolate's assets, it's the customer's assets, right? We just manage it on behalf of the customer. So what Chocolate Finance has really done is taken this idea of how can we use the core backbone of how investable assets can generate yield and package that up in a way that delivers daily liquidity, daily returns, instant access, and all of the cool stuff that you'd expect from how money management works. And that's what we do.
Now, I mean, it sounds very simple, but if it would be that simple, every bank would maybe also come up with a similar idea. So why do you think no one else is doing what you are doing?
Look, there is a lot of technology that sits behind how we do it. It does look a bit simple on the front end, but behind it, it's a relatively complex piece of engineering. What we see in terms of how you manage customers' money is much more of an actuarial or an insurance forward-looking way on customer behavior and asset returns, rather than a traditional asset management view, which is how do I beat the benchmark on the fund that I'm been building. There's a lot of tech around money in, money out, reconciliation, transaction monitoring, KYC, all the banky stuff that you have to do in terms of operating cash management kind of solutions. And so it is complicated stuff. But I think as per your first question, with the evolution of technology, AI, all of these tools that become available to us, we can deliver these solutions with very, very, very low cost. Very low cost, to the extent that we think that the advantage that we have in terms of the low-cost model of super tech gives us a significant permanent advantage over much bigger organizations doing similar kinds of things. That said, in comparing ourselves, if you're asking, why doesn't a bank do what Chocolate does? Well, banks actually need the deposits in order to lend them, right? Banks can't really, banks or insurance companies are quite limited in the assets that they can put your deposit into, right? So it's either a loan or it's government bonds backing deposits for banks or insurance companies is significantly limited by the impact on risk-based capital and capital that goes with that. Whereas in Chocolate's case, we're pretty much unrestricted. But the thing for Chocolate is that we can't use that money to fund a bank's loan book, right? We can only do it in a certain defined way to manage a customer. So we think that this is not something that actually fits well with a bank's model. Banks will be banks and take deposits and lend money to people. We will just manage the cash side of the thing, and it's a different model. So it's different, and so I don't think banks really want to play in this space because they have a different model to what we do.
Of course, yeah. I mean, the cost of the platform is one thing, but there's also the customer acquisition costs. Is there anything you had to do to really get enough traction in the market, or is it the name, the brand that helps you enough that you get enough customers?
Yeah, in retail business, there are so many factors around customer engagement, right? Brand, as you say, is one thing, and we're thrilled with our brand. Everybody loves chocolate. Chocolate makes you happy, and we want you to be happy about your money. But not only did we come up with a great brand and a cut-through brand, we executed it really well, I think. Well, the evidence suggests that we've executed really well because the business is doing really well. But people have responded incredibly well to the brand. Take-up of our product has been unbelievable. Operating at kind of double our expectations when we started. It's done really, really well. But what we found really is that in customer acquisition, consumers are looking for something that they can love, not just something that meets their purposes. And so we've spent a lot of time and energy on simplifying and curating a positioning around the Chocolate Finance brand and around the core product that we do to create an easy way for customers to just see this as a no-brainer. Everybody needs a chocolate account because it's super easy to get, and you can get a better return on your cash. Why wouldn't you take it up? So if the brand is great and creates followership and the product is good, you've got an excellent recipe, which means that your customer acquisition cost is incredibly low.
Brings me a bit more to what's forward-looking. What do you envision in terms of growth? Go geographically beyond other markets, or you see any other visions for the product? What's next?
Yeah, look, I think Chocolate has started off as a cash management tool, and we did that deliberately. Even though we have the ability to do full range asset management services, we took a view to position ourselves first and foremost in just looking after customers' cash. And that was a very deliberate move, thinking through how do people make decisions, right? And in a world where there is so much choice available to customers, there are so many banks, so many asset managers, so many wealth tech platforms, so many options. How do you position in a way that you can gain as much simple traction as you possibly can? And the answer is quite simple when you think about it, is only do one thing and do it really, really well. So if I come to you and say, here's a list of 10 different investment choices, right? You're going to want to analyze all of those things. You're going to then say, okay, these are investment choices. Okay, Chocolate's offering those, but A, B, C, D company is also offering investment choices. And all of a sudden, you've got a lot of deer in headlights or analysis paralysis and or inertia around decision making. But if I come to you and say, do you want 3.6% return on your cash, and you can sign up in a couple of seconds or minutes, and you can access your cash in any time, it's not a very difficult decision to make. It's a yes/no thing. There's not a huge amount of analysis. Of course, you go to the bloggers and the websites and the press and everybody else to check, is it legit? And of course it is. It's regulated, all that stuff. But it's a very quick and easy decision for customers to make. And so it's, in terms of product lineup and on expansion, we start with cash, right? The expectation is obviously more, right? There is how do you deepen the relationship with customers? How do you move eventually from cash towards longer term savings, retirement solutions? Everything that's around a customer's wealth is eventually going to be there. But that's not where you start. You start at the top of the funnel. Geographically, to your question, the beauty about super tech in today's technological environments is when you're starting off a clean piece of paper, you can build a technology enterprise which is designed from day one to be geographic agnostic in terms of its core capabilities. Of course, there are nuances around regulation and funds and settlements and clearing accounts and all the technical bits, which are really just technical adjustments. But the core proposition remains the same everywhere. If you're in Singapore or anywhere in the world, most people have got cash sitting around doing very little, and that's a problem we can solve geographically wide. Yeah. So for us to just stay as a Singapore company actually significantly utilizes the technology that we've built. So the question then is how quickly and how fast do we expand? And that means getting the right balance between getting it right before you go. There's the phrase you can say, nail it and then scale it, right? So we nail it first in Singapore and then scale it around the geographies as we go. But more pointedly, we are already exploring 3 other markets where licensing and other things is underway. Of course, can't say until these are all complete, but well on our way to global domination.
It seems that it will still be very busy in the coming years, but still, if I may ask more broader questions in tapping on your experience, what are maybe 2-3 other areas where you will feel there is a gap like what you've addressed, and maybe you don't want to share the next business idea you have served for yourself for 3 to 5 years from now, but any ideas, and especially when it comes again to this democratization of finance for the normal person? Are there other things where you feel that banks are not, or insurance companies are not doing enough, or really the future vision you would have for either yourself or the industry?
Yeah, look, on the insurance side, as an insurance guy, I'm an actuary by training and I've been in insurance most of my life. I still believe that the insurance industry is incredibly inefficient as a way to save money as a retail customer. I think there are much better, more efficient ways to do it. So I think a massive challenge for insurance companies is how to reduce cost in the operations of growth or investment style of insurance products. Of course, protection is always there and necessary, and the domain of insurance companies. But I really don't think that insurance companies are doing a good job for retail customers from growth or asset generation products. On the banking side, look, banks are banks, right? They're big and strong and lots to do. There are some guys, like you say, in Hong Kong on a lot of efficiency coming through digital licenses. Again, issues around customer acquisition, differentiation. If you've got 10 different digital banks doing more or less the same thing, how do customers differentiate? Blah, blah. There's lots of things to think about. There's always opportunities to optimize things. I think in emerging markets, lending rates are too high. I think most banks operating in emerging markets are usury in their what they extract from poor people in lending money. I think the margins, as you see from lending in developing markets, are outrageous, and I think banks will get challenged significantly in their do the right thing for people. So I think those changes are all challenges which banks will have to face as we go.
And how do you think then the impact is from an insurtech, fintech point of view onto the larger organizations? Is there, of course, it's a bit of disruption, but for sure also a positive impact?
I think it is a positive impact. I do feel very strongly for the insurtech and the fintech guys that are struggling to build businesses. Building businesses from the ground up is really hard. And especially B2B businesses in the financial services sector, because building a B2B relationship into an insurance company or into a bank is not an easy thing to do. There are too many people in insurance companies and banks whose job it is to say no, right?
Yeah.
Or there are too many people in insurance companies and banks who realize that to say yes to some of these insurtechs actually means that they no longer have a job. And so there are massive barriers for some of these startups to come together with. Also around that, what I have seen in my own experience was this: when I started Singlife and we were raising money, the first people we went to were big insurance companies to say, hey, you should invest in a digital ecosystem so that you can optimize your own digital way of delivering insurance. And I found really that the arrogance of the incumbent industry was, yes, this is all great and all that stuff, but we are ABC big insurance company. Surely we are big and powerful enough to do this ourselves, right? And so you spend a lot of time showing people the color of your underwear as an insurtech or as a fintech, only to be kind of used as a research article. And it's really, really hard for insurtechs and fintechs to get it growing.
Yeah, and I think this first principle thinking that you need to really start sometimes also from scratch makes a big difference compared to if you have, of course, that much legacy. And yes, you find these fintech departments or innovation teams in every big organization, but it's still not the same. And especially, as you said before, if you're an entrepreneur and you have to really put all your heart and soul into it, for sure that gives a big difference that you don't have in a protected environment.
But even in a protected environment is a misnomer, right? So, in big organizations, if you look at the biggest resource of any company is people, right? People are the most expensive things you can have. Yes, tech is expensive, but if you spend wisely, you'll have less people. So there's a balance. But the thing about people is interesting in that, and one of the reasons big companies have become slow is because in the world of people, 1 + 1 does not equal 2, right? Because 1 + 1 have to spend 20% of their time talking to each other. And so 1 + 1 is actually 1.5. 1 + 1 + 1 is nowhere near 3. It's probably like 2.1. By the time you get to 4 people, you're actually only 2 people. By the time you're 10 people, you're still 2 people because you're wasting so much time messing about with all of the, getting stuff done, right? So scaling on people is not always a recipe for going faster. Actually, reducing people is a much, much stronger recipe for efficiency just because of better communication in organizations. And that's why startups, early stage companies can move so much faster just because they don't have the friction internally around structures, which big companies challenge on a day-to-day basis.
I mean, you've worked with some of the biggest corporates in the world. Now, after many years in the startup environment, what would be the first thing, if you could, and have full flexibility, you would change if you would go back into a big corporate?
I would probably Thanos most businesses. Click your fingers and 50% of the people disappear on a random basis. And you'll probably find that the organization operates maybe 90% as well as it did before with half the cost. I really do believe that, especially now with the advent of AI, agentic structures that can now start to fill roles, in big organizations now, there will be massive, massive pressure to cut cost, but also massive, massive resistance because as big organizations, you're loyal to your staff. You're loyal to the people that have built the businesses so far. You're loyal, and there is regulatory and systematic obligation to do well for the people that work for you, to employ and grow. And these are challenges for big organizations to deal with.
Yeah, absolutely. The Elon Musk approach of going into Twitter and first cleaning up, it's definitely interesting to see what still works with maybe half the people. We are already quite advanced in terms of time. There's so many things I would still love to discuss with you, and maybe in the next podcast, but maybe a future outlook once again. I know you won't be found at the beach after Chocolate Finance, but is there anything you would be able to share of what could come next in 10, 15 years after Chocolate Finance, or is this
for me?
far
Or
away?
yeah. Look, I just want to wake up in the morning every day and say, yay, I love my life. And if that means I'm building businesses or riding my bicycle or playing golf or whatever that means, I just want to find a way to be happy. And then at the moment, I'm most happy when I'm building cool stuff. I try and balance it as much as I can with sport and other things that all fit into that. But, I'm halfway to 100. So I've got lots of time and energy left to spend time with the people I want to spend time with, and do the things I want to do, and just keep having fun, right? That's if you can't have fun with what you're doing, then what's the point?
Keep having fun, and as you said, also happy money, happy life.
For sure.
Good vision to have. So thank you so much again, Walter. Great to have you on the Pulse Check podcast. We for sure find you on LinkedIn and social media, and you also find us, the Synpulse 8 Pulse Check podcast. Thank you once again, Walter.
Happy to be here.